Hey everyone, thanks for joining me. My name's Ben and I hope you're having a good start to the weekend. Now, in the financial world and the investing industry, there is a lot of terms that float around, and by understanding these terms, it can make it easier for us to evaluate companies and apply them in more complex formulas and everything like that. Today, we're going to jump in and we're going to have a look at the price to earnings ratio. So what is the price to earnings ratio? The price to earnings ratio is sometimes expressed as the PE ratio, and what it is a way of valuing a company that measures its current share price relative to its per share earnings. You can use the PE ratio in multiple formulas in a way to attempt to ascertain the intrinsic value of a particular stock, and you can also use it to compare two companies in the same industry by comparing their PE ratio. Generally, you're looking for a lower PE ratio, as a particularly high PE ratio would imply that that particular company is overvalued. In order to find a company's PE ratio, we do need a couple of things. The first thing we need is the current share price of the company, and the second thing is a company's EPS.
But Ben, what is an EPS?
Now, that is a very good question, and I'm going to do a future video on EPS in a more in-detailed version. However, the TLDR version is an EPS stands for the earnings per share, which is calculated through dividing the company's profits by the current outstanding shares. Once you have the share price of the company and the EPS of the company, the equation is fairly simple. All you do is divide the share price by the EPS. This will give you the company's PE ratio. You can use the same information to produce the company's earnings yield, which is just the EPS divided by the share price, and that is expressed as a percentage. But we can ignore that for this video and we will look into that in the future. But today we're just looking at the PE ratio. Right, so let's jump over to an example to see if we can get a better understanding of this. And we're going to assume that we have two companies. First, we have company A, and that's trading at a share price of £50 per share. Secondly, we have company B trading for £10 a share. Now, a new investor may at first just look at these share prices, see the lower value of the £10 share on company B, and assume that is a better value because it costs less money and you get more of them. However, in investing, that's not necessarily how it works, and the PE ratio can help with that. So we're going to now move on and we're going to look at the finances of the company just to fill out the rest of the example. So looking over to the made up financials of these companies, and we can see that company A has made £100,000 in profit in the last year. However, comparing that to company B, who only made £20,000 profit, you may potentially be thinking, it's a better deal to go for company A because they make more revenue. They've got more profit that is going to their shareholders. And while, yes, that is true, that more money will be going to their shareholders because they've made more profit, the issue is you also have to take into account the outstanding shares and how many shareholders that profit is being attributed to. And that's where the EPS and the PE ratio come in. So in order to relate the share price to the profits, we can calculate the EPS that we mentioned earlier by dividing the profits by the outstanding shares. For example, we would say that company A has 60,000 shares outstanding and company B have 20,000 shares outstanding. If we work out the EPS of the companies by dividing their earnings by their outstanding shares, this brings out company A with an EPS of £1.66, with company B showing an EPS of just £1. Now that we have the EPS, we can actually work out the PE ratio for each company. Doing this now, we can see that company A comes out with a PE ratio of 30 compared to company B that is coming out with a PE ratio of 10. So what this would show us is potentially company B is actually undervalued and potentially a better deal, even though they make less than half of the profit of company A. This is mainly because as retail investors, we don't necessarily have the full capital to go out and buy a complete company outright, Warren Buffett style. So because of that, we don't care about the overall profit and revenue as it relates to us. What we care about is our percentage of those revenues. Obviously, as with basically any ratio and any metrics to value a company, you should use it in conjunction with others and form an overall conclusion based on your knowledge of the business and whatever metrics you've used. But the PE ratio can be a cornerstone of that analysis for the company. Now, like most ways of valuing a company, there are always limitations, and as mentioned, you should always use metrics in conjunction with other forms of valuing a company to get an overall opinion. One of the main issues for the PE ratio itself is it's very difficult to use the PE ratio to compare companies in different markets. This is mainly because companies in different sectors will generally have different growth rates, different payout rates, and different factors about them that will make them very hard to evaluate. You can use the PE ratio in one sector, so comparing finance to finance can sometimes work, but I wouldn't suggest going and comparing a tech stocks PE ratio to a industrials PE ratio, because there is no way they're going to relate, because they're very different businesses and different ways of operating. Another limitation would be that leverage for the companies is not taken into account and can skew the PE ratio. For example, suppose you had two companies that were in a similar sector and they only differed primarily by the amount of debt that they had. The company with more debt would have a lower PE ratio, and the company with less debt would have a higher PE ratio. However, ideally, if business went well for both companies, the company that took on more debt would perform better because they've had more capital to reinvest. So it would work out with better earnings. However, you have to look at the overall financial picture of a company to know what you're investing in. When looking at a company's PE ratio, it is worth considering sometimes the average PE ratio of the sector that they're in. This way you can see if one company is potentially performing better than its competitors. As an example of this, it's estimated that the US finance sector's PE ratio is 10.60. Therefore, if you found a company that had a PE ratio lower than that, in theory, they are a better value than the average competitor and company in that sector. Now, that all sounds well and good, but unfortunately in investing, it's never as simple as,
Oh, look, that company has a really low PE ratio. Therefore, it's a bargain. I'm going to go out and buy hundreds and hundreds of shares as soon as I've smashed that like button.
and this is because of how the PE ratio works. For example, if you had a company that was in fundamental decline and had a generically flawed business model and was due to go out of business, the PE ratio may show you that as an attractive buy, because all the investors that know about the company have bailed out because they know it's going downhill. If you haven't done your research and you just go off the PE ratio, you may buy into that company just to have it crumble at your feet around you, and you've lost your valuable investment. Now, that is the very basics of the PE ratio, and we even sprinkled in a little bit of EPS for you. So if you are interested in evaluating companies going forward, I have got a video that doesn't use the PE ratio, but is a good way of potentially evaluating a dividend paying company. So if you want to check that out, it should be appearing now. And in the meantime, have a good one, and remember to invest, save, and subscribe.